It's time for Yahoo Finance's Market Minute. Stocks selling off, the Nasdaq leading a lot of those losses as investors worry President Trump's tariff policies could lead to a global trade war. Apple shares down over 7% as several of its main production hubs could be hit with the new tariffs. The tech giant has tried to stay out of the crosshairs by moving out of China to countries like India and Vietnam, but now they are facing double-digit tariffs as well. Nike and Lululemon both sinking on the tariff news. The retailers relying on Vietnam for manufacturing, the country now facing a 46% tariff rate. Nike made 50% of its footwear in Vietnam in 2024. Lululemon made 40% of its products in the country. Walmart, Amazon, Target all under pressure as the wide-ranging tariff plan is expected to lead to higher prices across product categories as consumers are already pulling back on discretionary spending. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code to track the best and worst performing stocks.
Welcome to Wealth. I'm Julie Hyman, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks you need to grow your money. On today's show, the stock sell-off is intensifying. So how should investors navigate the uncertainty? We'll get advice from a portfolio manager to start the hour. And President Trump unveiling sweeping new tariffs. How can you expect them to affect the cost of everyday items, like your next tech purchase, for example? We'll discuss. Plus, all week on Wealth, we're talking about student loans ahead of the 25-26 school year. Today, we're digging into how student loan interest works and how missing a payment can affect your credit. You don't want to miss it. First up, we got to take a look at what is going on in the markets here. 90 minutes into the trading day, stocks are plunging here across the board. The S&P 500 is on track for its worst drop in 2 years as President Trump announces sweeping new tariffs, escalating fears of a global trade war. Joining me now is Margi Patel, Allspring Global Investment Senior Portfolio Manager and Head of Capital Allocation. Margi, what should investors do right now? They're looking at this sell-off that, by the way, is not in isolation, right? We've already seen stocks pulling down this year. So what should investors do as they see this happening?
Well, I think what they should really do is nothing, because at this point, we really don't know what the effects will be on the tariffs. It looks as if short term it may be negative, but longer term, it looks as if it will be on balance positive for the U.S. economy. Some of these unfair trade barriers really did hurt our domestic base in the industrials, and I think that that will be corrected. And really, these actions have been extremely sudden. We're not used to seeing that. And I think looking at President Trump's economic team, they're very smart, successful people. And if it looked as if we're going to have disaster the way some of the stock prices tell us, I think they can pull back just as quickly as they advanced on these. So bottom line, I think long term it's positive for the U.S. And when we don't really know anything about the market, it's best to do nothing and not follow the lead of really short-term traders who've driven down the market pretty much this year.
Do you think that there's a case to be made for taking any kind of defensive posturing in the market?
Well, from the stocks have done the best. They all have gotten really hit the hardest. Those are the sectors that I think long term will still be the strongest. Now, for example, technology, industrials are related to capital expenditures and improving the electrical grid, and also domestic energy, which I think will be a strong area. And I think, like I said, I think it's important to keep in mind the volatility is really driven not so much by people who know more than the average investor, but really short-term traders, which is really dominating, I'd say, way over half of all the trading. I think actually in the financial crisis, giving up the uptick rule, which limited the downside action of stocks when people wanted to short, has really caused a lot of this volatility that's so disturbing.
But Margi, it's not just short-term traders. People are worried, right? You look at consumer surveys, you look at CEO surveys, you look at some of the early indications we've gotten on earnings. None of that's been good. So, it's not as though the stock sell-off is just based on only short-term traders. There are some bigger forces at work, no?
Well, that's right. And I think the biggest force of all is coming into the new year. You really had to realistically expect rather modest growth in the U.S. economy. I was really thinking, say, 1.5%, 2%, which is lower than many estimates. And I think part of that is we're seeing a deflation in stock values. But still, when you look at the market, we had before this 2 fabulous up years, 25% for the S&P in 2024 and 23, and then we had a down year previous to that. Before that, we had 3 up years, and we haven't had another down year since 2018. So I think we've been kind of spoiled with positive markets. But I do think when you look at even sectors like technology, yes, there's a lot of concern about the tariffs and slower demand and so forth. But even if you haircut their growth rate, many tech stocks are trading really with a lower price earnings ratio than the average S&P stock, or really slightly in line or a little above. So we think that many of those are bargains. But I do think we aren't going to see the market stabilize until we have something to crystallize, some positive event, whether it relates to tariffs aren't as bad as we thought, or there's a change. Maybe the Fed will cut rates instead of keeping a stable policy. So I think we may have to wait another quarter or so to see the market find its footing. And then I think it'll do better because the U.S. economy is strong. In fact, you saw the other day, auto sales were very strong at a 17 million rate. And
well, that's because people were buying cars in advance of the tariffs, no?
Well, correct. But still in all, if you don't have the money to buy a car, you're not going to buy a car. So it's a very good current. People have money in their pockets to buy cars. Even if you haircut back to 16 or even 15, that's still quite strong, indicating consumers, they may be worried, but basically the job market is okay. The numbers today were okay, mixed and looking at modest growth, which is what we're looking at. So we think that it's best to just hold tight, not pay attention to the market and say, well, you have to expect every few years you have a negative year. And over time, you'll still make more money than if you were in risk-free assets.
Margie, I'm curious about the next potential catalyst, jobs on Friday, right? And how much is riding on that now, especially given what's going on in the market today in the wake of the tariff announcement?
Oh, I think that these monthly numbers that we see are too small to move the needle and say, oh, it's okay. We can jump back in the market. I think it's really the bigger picture of what's happening with, particularly with tariffs and how U.S. companies react to those. But really, we really have gotten to the point where we had to do something. And if you look at Europe, Europe is absolutely just sinking in the mud. They are way over indebted. Their economies are basically absolutely flat. They have no promise of growth. So you can see why they're very, very disturbed by these tariffs. But I really don't think it's going to roll over to the U.S. economy. I think we're going to be able to have positive growth. And as I said, if I were going to look at averaging in, I'd say put 10% in today, 10% in next month. And I think in the next 6 months, we'll be pretty pleased.
Margie, good to see you. Thanks so much.
Thanks a lot.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Joining me now, Catalyst host Madison Mills. And today we're looking at Conagra Brands, Lamb Weston, and Best Buy. Obviously, there's a lot of selling going on right now, but we found a few names that are moving for specific reasons as well. And actually, 2 of them are moving up. First up, let's talk Conagra and Lamb Weston, both in the food business, both rising after earnings. Conagra did miss on the top and bottom line. It kept its annual forecasts unchanged. And Lamb Weston, best known for its frozen French fries, they're a big supplier to McDonald's. They topped earnings expectations. Both companies, though, did warn of macro headwinds to come. And it was quite interesting, Maddie, to see in particular Conagra up, maybe because it's stuck with its forecast.
Yeah.
But because the numbers weren't great.
The numbers weren't that great. It's interesting too, and you mentioned some of this is based on the company fundamentals. Taking a look at Lamb Weston, back in July, they had a quote disastrous report according to one analyst because of global restaurant traffic and menu price inflation. So a good reminder that the inflation problem was already in the room before these tariffs. Now you have tariffs potentially fueling even more inflation, but perhaps based on this earnings print from Lamb Weston, their quarterly results coming in above expectations, maybe they're well positioned to handle any impact of those tariffs, at least in the short term. We're hearing, obviously, tons of calls this morning that in the second quarter earnings, we may not even be getting forward guidance from a lot of companies. So it's going to be hard to suss out the growth path moving forward.
And Lamb Weston also hired Alex Partners and said it was evaluating opportunities for value creation and cost savings. That cost savings piece of it, I think, is really what investors are keying in on here, because the CEO of the company saying in the release, we expect headwinds from soft restaurant traffic to persist, and we continue to see opportunities to further streamline costs. So it looks like the cost part is really what people want them to improve.
And I guess if they have some of the pricing power, then maybe that positions them well as well. But I think it's going to be really hard for analysts to tell who has pricing power right now, as they're doing a lot of math to figure out how tariffs impact.
For sure. All right, let's talk about another company that is being affected by tariffs and also a downgrade. Best Buy sinking after Citi cut its rating to neutral from buy. President Trump's tariff policies pose a risk to the company's sales, in the view of the analyst, who says that Best Buy could see consumers pull back in this uncertain macro environment. So sort of like the double whammy there. On the one hand, a lot of the stuff it sells is going to be tariffed. On the other hand, consumers might not be too excited about buying.
And this comes after we've already seen a couple of downgrades to Best Buy over the past, at least in the month of March. We saw a couple from the likes of Morgan Stanley, from Telsey and Piper Sandler as well here. Morgan Stanley talking about maintaining their equal rate rating, but cutting the price target from $100 to $85 here. Best Buy is one of those big box retailers that obviously sells a lot of tech, right? Computers, phones, all of which could potentially become more expensive due to these tariffs, especially the tariffs coming out of Asia, or being put on Asia, I should say. So are consumers going to be able to withstand the hikes of those prices, or will they stop spending? Based on the stock reaction, it seems like there's a thought that spending will be.
And if Best Buy doesn't pass on all of the costs, what does that do to their margins?
Right. And do we see more layoffs? We already had the first layoff domino drop with Stellantis this morning. Do we start to see that from other companies?
Yeah, well, we've got a good guest to talk about that later on.
Oh, great.
But in the meantime, thank you, Maddie.
Appreciate
it.
Thank you.
During times of market volatility, 73% of retail investors maintain their existing investment strategy or use it as an opportunity to buy more investments, while only 8% react by selling off their investments. That's according to a new study from trading and investing platform eToro. Joining me now is Bret Kenwell, eToro U.S. investment analyst. So that all may be the playbook normally, but today is not a normal day, Bret. And so I'm curious if even on a day like this, you see retail investors buying the dip.
Yeah, so when we did this survey, just for context, the dates were, we did it between February 18th and March 4th. So it really caught, the high in the S&P, and then, those really kind of the first half of the correction. And, to me, it came back as surprisingly optimistic, surprisingly positive, certainly stronger than I thought. But I do imagine that sentiment has taken a little bit of a hit in the recent weeks. Just as like everything else has kind of come in and come under pressure, we see confidence continue to move lower. We see investor sentiment continue to move lower. So I wouldn't be surprised if retail hasn't been able to buck that trend as well. But it's going to really depend on how things shake out going forward from here, whether that's related to the tariffs or more importantly, as it relates to the economy as we kind of sort through Q2 and push into the second half of the year.
And Bret, what do we tend to see at times like this when things get even more volatile? And what kind of action do you tend to see, and are you seeing on the platform?
Well, as it relates to retail investors in general, I think at first they have a tendency to really embrace the dip. Going back into this survey, we asked specifically about holding periods and how long investors, what their time frame generally is. And a majority were in either measuring between years or decades. So this tends to be a group that looks a little bit longer term. And when we're kind of dealing with that, in the context of time frame, it's easier to deal with these sort of periods, even though this is a hard, period to navigate with volatility, emotions are high. When your outlook is in the years instead of weeks or months, it's a lot easier to embrace a 5 or 10% correction. If we get into that 15, 20% correction, tiptoe into a bear market, then I think, it does get a little harder to embrace those dips. We saw retail appetite for the dip pretty strong January, February, but I think that appetite has waned a little bit, as has patience and as has certainty, really over these last 4 weeks or so.
What about when it comes to big cap tech, which has been the thing that has been, probably what retail and institutional investors alike have been most enthusiastic about, the AI trade, et cetera. Is seeing any wavering there?
Interestingly, I personally think that a lot of the sentiment declines in market-wide sentiment are tied to tech. When you look through dig through the Q1 results, the performance results of the S&P sectors, a majority of them did pretty well. The weakness was really tied to consumer discretionary and tech, which, in this case, unfortunately, accounts for more than 40% of the S&P 500. So a bulk of the sectors actually outperformed the index itself, but that weakness in tech really weighed things down. Now, what's surprising from the survey is how sentiment didn't really waver from, quarter over quarter. Confidence in Magnificent Seven stayed the same. 48% of respondents expect the Mag 7 to outperform the S&P this year. Confidence in AI stocks actually went up quarter over quarter, which again, so when we did this survey, it was after the DeepSeek news, after the volatility in AI. It was once tariffs were on the table. So to not really see the confidence waver in mega cap tech or in AI was surprising to me.
And did you see any changes from sort of different demographics on the platform?
Yes, Gen Z wasn't an asset class; it was a generation, and it was Gen Z. They really, I think, from the survey results, they seem to have really kind of handled the moves in the market really well over the last 6 months. So when we last did this survey, again, for context, the prior survey was done between late November and early December. And we saw this really risk-off rotation from Gen Z. So they were rotating into cash, rotating into bonds, which was, surprised me because it's a younger generation. They tend to have a larger risk appetite and be more risk on. Fast forward to this quarter, now we're seeing all that rotation come back out of cash. They went from 75% of respondents saying they had a cash position down to just 60%, but big increases across the board, whether it's in crypto, domestic stocks, foreign stocks, commodities, which our read-through was silver and gold in that scenario, but really kind of embracing all sorts of different asset classes and sectors, which is, in a way, it looks like they took advantage of the big run-up in Q4 and are trying to take advantage of the dip in Q1.
Brett, thank you so much. Appreciate it.
Thanks for having me.
We want to take a check of the markets as we head to break here. We've got the Dow trading lower by 1,400 points, just off the lows of the session, but still down sharply. Some of the worst performers there: Nike, American Express, Goldman Sachs, Amazon, and Apple. Those are the worst performers in percentage terms at the moment. Nike down 13%. Coming up, we'll dive into how tariffs will affect consumer tech. That's next on Wealth. Tech stocks leading a lot of this morning's declines. We've got Nvidia, for example, down by 6.5%, among other things. It got downgraded over at HSBC. Meta off by 7%. Microsoft off a relatively less 2%. Alphabet off by 3%, but collectively the Magnificent Seven are now down 20% from their highs. Apple is the worst of the bunch in percentage terms because it relies so heavily still on China for making its products. Tesla down 6%, Amazon down over 8%. This, of course, as tariffs ranging from 10% to 50% are expected to have a huge effect on the sector. A majority of tech imported to the U.S. is made in Asian countries like China, Vietnam, and India. Joining us now to discuss how tariffs will affect U.S. consumers is Sean Duberback, the chief economist at IPC. It's a global association for electronics manufacturing. So, Sean, we're talking about all kinds of consumer tech here: cell phones, laptops, gaming consoles. By and large, where are these things made? In these tariffed countries, we know, but what kind of percentages are we talking about here?
You're talking about a very large percentage coming from overseas, as you already noted. China is a main supplier of electronics to the United States, but so are other countries that are impacted by the tariffs that were announced yesterday, places like Vietnam, India. Overall, I would anticipate if things continue the way they are, that we could see prices increase for a number of these products close to 50%. So you could have a quite significant jump in prices in the coming months as a result of these new tariffs.
Is there any way of quantifying what people maybe can expect, Sean?
Yeah, if you look at laptops, we're probably looking at just under 48% increases in prices. Again, because laptops are primarily coming from places like China and Vietnam. Smartphones, we anticipate a 48.8% jump in prices. Video game consoles, just under 50% jump in prices. So you anticipate a big jump in finished goods. And then there's also a lot of components that are coming from overseas. And those components are being built into electronics products that may be produced here in the United States, both for consumers and for broader industry, for defense, for aerospace. And so it isn't just the consumer electronics products that are manufactured overseas that will drive prices up, but also the increased cost of components will drive up domestically produced products as well.
I mean, this is pretty incredible, the increases that you're talking about. I thought it was interesting, a recent survey that you all did kind of got an idea as to what companies were trying to do to deal with this. And you found that 31% of manufacturers had invested in automation or optimization to try to counteract the effect of tariffs. 28% had switched to non-tariff suppliers, although that's kind of out the window now, right? Because everybody's now tariffed. But what kind of things can they do to manage around this going forward? What are you seeing them do in real time?
Yeah, you're seeing electronics manufacturers around the globe really try to address these price increases. As you noted, our research finds that they're looking at alternative sources. They were looking at alternative ways of keeping price increases from moving through the supply chain. And at the same time, it will be impossible to address all of these cost increases. They won't be able to absorb them all. And at the end of the day, you will see these price increases pushed further down in the supply chain to the end user. Sometimes that's the consumer. Sometimes, again, that might be a business if you're thinking about aerospace or defense, where those costs have gone up as well.
And Sean, we had an earlier guest today talking about that it wasn't necessarily the what that the market and manufacturers, et cetera, were opposed to. It's the how. In other words, the idea of reshoring some production maybe is a good idea. It's that, is this the right way to do it? And I'm curious if that's something that you're hearing from your members, and if so, what would be the right way to do it in their view?
I think one of the biggest challenges that I see with our members, with electronics manufacturers, both here in the U.S. and elsewhere, is the dealing with the uncertainty factor. They can start to operate in a known environment and address things as they exist. The challenge that they are confronting is that things continuously change, and they're having to reconsider what approaches to take. And I think not just for consumer electronics manufacturers or electronics manufacturers broadly, but every industry is dealing with this degree of uncertainty in how to address a changing spectrum of challenges.
But I guess even if there is certainty, if the certainty is, for example, 54% tariffs or 46% tariffs or whatever, even 20% tariffs, it's not great, right? If you have the certainty and it's that bad, it's still tough to manage.
Yeah, and I think that the other challenge to make note of is that tariffs impact not only products differently, but they impact different priced products differently. So, for example, a high-priced product might have a little more margin in it, and as a result, you can absorb some of those price increases before passing them on. Lower-priced products generally have much lower margins, and it's much harder to absorb those price increases that you might see from tariffs, and so you end up passing on a larger share of those tariffs. And so I think one of the challenges and ultimately one of the risks for U.S. consumers is that the products that will be impacted the most are the lower priced products, which might be impacting a certain household in the U.S. that's looking for cost savings or that doesn't have the funds to spend on higher priced products, and they are at risk of being impacted the hardest.
Sean, thank you so much. Appreciate it. And let's take a look at the S&P 500 as we head to break. It is on pace for its worst day in 2 years, down by 4% right now. Coming up, layoffs jumping in March, why Doge could be to blame. That's next on Wealth. You're You're watching Wealth on Yahoo Finance. Let's get a check on markets here as we continue to see this sell-off. The Dow right now down about a little over 1,400 points, 3.25%. The S&P 500 off by 4%. All of them hovering around the lows of the session. The Nasdaq has been performing the worst of the three major averages. It's down by more than 5%. The Russell 2000 of small caps down more than 6%. And if you look at the year-to-date chart here, from the high to the low, this is now off by 20%. So that would be a bear market. That is a 20% drop from high to low if it does close at these levels, or really close above, I believe it's 1954 or so. So we're going to keep an eye on that. Now, where are investors going, if anywhere? We're actually seeing a little bit of buying in two sectors here today. One of them is consumer staples, so that has a more defensive profile. It also includes some of the food companies we talked about earlier, like Lamb Weston and Conagra, and utilities, which also tend to be a place that investors go when they're looking for safety. On the flip side, we've got energy down, we've got tech down, we've got consumer discretionary industrials, anything that's got a whiff of being more economically sensitive or sort of risk sensitive is down sharply in today's session. And I want to get another check on the Dow and what we are seeing here, because again, there are some more green creeping onto the screen here. Procter & Gamble here is up, Johnson & Johnson, Coke, McDonald's. So it does look like we're starting to see some buying in some of these companies that are seen as perhaps less exposed to the tariffs. For example, Verizon, in theory, would not be as exposed, but still steep declines in tech. The likes of Disney down 6%, Caterpillar down 7%. So still quite a lot of sharp declines. Well, the number of announced layoffs in March jumping 60% from a month prior as DOGE enacted plans to eliminate positions across the federal government. Federal layoffs accounted for nearly 80% of total cuts during the month. That's according to a report from Challenger Gray and Christmas. Joining me now to discuss is Andy Challenger. He's Senior Vice President at Challenger Gray and Christmas. Andy, it's good to see you, even though the numbers are not great here, to say the least. How unusual is it to see this kind of an uptick, especially from what is essentially one employer?
Yeah, it's a huge uptick, but it's also just a huge overall number. In fact, outside of 2 months during the peak of COVID, this is the highest single month of job cut announcements that we've tracked since we started doing this 35 years ago. This is a really big number. The vast majority, about 250,000 of the job cuts that we've tracked this year are coming from the federal government. It's a really concentrated sector to be seeing this many cuts from, and it's totally anomalous. It's something that we've been really surprised by.
And what I also thought was interesting is there are a lot of sort of lawsuits that are ongoing right now to try to get some of these people back to work or to block their firings. This doesn't even account for, in other words, like this is those people who have more definitively lost their positions, correct?
Yeah, we're not counting those individuals that are probationary, there's still a lot of court issues that have to be resolved before we know if those people are going to be let go. These are job cuts that have already happened or been officially announced and seem to be going forward in the next few weeks and months here.
Andy, what do we know about whether these folks are being absorbed back into the workforce?
We don't have too many signals on that yet. I think there's an expectation that we're going to see some jobs added to the economy in Friday's job report, but there's not an expectation that we're going to see a big surge, certainly not one big enough to absorb this many people coming out of the federal government. This is a real inflection point in the labor market overall, with slow cooling for 2 years, hoping for that nice soft landing. And these cuts are actually coming at a time when there's a lot of economic news coming out that looks like headwinds for companies over the next couple months and years.
So what signs are you going to be looking at then going forward? What, and was this sort of it in terms of most of the government cuts, or I guess it depends on the outcome of some of those legal proceedings?
It's possible it could spike further, cuts from the government. I don't expect it to stay at this pace in any way. These are such large cuts to be announced over just a 1 month period. The expectation is that this will hopefully start to cool down, and we'll be able to see the labor market and economy balance out, but obviously not good signs coming from the labor market piece of the equation.
The underlying cuts that we saw in other industries, ex-government, it looks like technology and financial were the other areas that saw the highest number of cuts, around 15,000. Is that sort of more in line with trend, though?
It wasn't very high in the private sector this month. However, over the last few months, we've been seeing an increase in layoffs coming out of the private sector as well. In our business, we're working with companies that are letting people go. It's been a very busy time this first quarter. We are expecting continued layoffs from the private sector as the labor market continues to cool. So that, coupled with the federal government cuts, could mean some serious damage in the next few months.
We'll keep an eye on it. Thank you, Andy. Appreciate it.
Thanks.
Well, President Trump's tariffs are hitting markets hard, and the uncertainty is making Federal Reserve Chair Jerome Powell's job harder. Here with more from Yahoo Finance Fed correspondent Jennifer Schonberger. It's not like his job is easy to begin with, but indeed, this puts him in a tough spot.
It sure does, Julie. Good morning again to you. President Trump, as you said, just made the job of the Federal Reserve more difficult after unveiling the most aggressive tariffs in more than a century, a move that has economists scrambling to discern whether this spells higher inflation or a recession. Hearing this morning from Evercore ISI, quote, the increased risks to both inflation and employment put the Fed in an even greater bind going forward. Evercore now says the likelihood of no cuts to more than 5 cuts in a recession scenario are all roughly equal. Their base case, though, is for 2 to 3 cuts. Meanwhile, Morgan Stanley went to no cuts this year, while Nomura went to 1 cut from no cuts. Traders overall reacting, boosting the number of rate cuts they expect this year to 4, with the first coming in June as they bet on a recession outweighing concerns of rising prices. Of course, the bigger question right now is how long will these tariffs remain in place and whether they could be negotiated lower or negotiated to go away at all. Chief economist at Wilmington Trust, Luke Tilley, tells me that he thinks that if these tariffs were in place for just 3 months, the economy goes into recession. He says the more challenging thing is figuring out how much economic damage is coming from uncertainty for businesses and consumers. He thinks that these tariffs increase the odds of recession to 50% now. In recent days, Fed officials have emphasized they want to keep rates where they are for some time as they digest the impact of Trump's policies. Some are still worried about inflation and aren't sure whether the impact on prices will be temporary or not. Inflation now stands where the Fed thought it would end this year at 2.8%, and JP Morgan is forecasting that we could see inflation rise by 1 to 1.5% because of these tariffs. That would put inflation in the 4% range for this year. We will get more reaction from the Fed tomorrow when we hear from Fed Chair Jay Powell after we get the March jobs report. Frankly, Julie, I think it's going to be more wait and see at this point.
Thank you, Jen. Appreciate it. Let's get a check of the tech-heavy NASDAQ as we go to break. It is doing the worst of the 3 major averages, off by nearly 5% right now. Coming up, a look at how tariffs could affect the housing market. That's next on Wealth. Uncertainty around the impact of President Trump's tariff policies looms over almost every aspect of our economy, including the housing market. So what do consumers need to know? Joining me now is our own Claire Boston. So Claire, we know Canadian lumber is exempt now from tariffs, at least for the moment. But what other items that go into homes could see an impact here?
Hi, Julie. So home builders are actually feeling somewhat okay about these tariffs. And that is because a lot of building materials at this moment appear to be carved out. You mentioned lumber. There will not be new tariffs on lumber. And then also home builders import a lot of gypsum, which is a component of drywall from Mexico. There's a Mexico carve out as well. Aluminum and steel won't see any new tariffs past that 25% that was previously implemented. But there are going to be some increases on things like appliances, which are very heavily imported from China. So builders are feeling okay about this. But there's still a lot of questions about what these tariffs are going to mean for the housing market. The big thing is that buyers and sellers right now are probably feeling a little bit nervous. They're looking at this plunge in the stock market. They're wondering what this means for the economy. That kind of uncertainty can really, really halt the housing market and kind of the spring home buying season in its tracks. And so some of the economists that I've talked to this morning are quite worried about that.
Yes, I can imagine they are. And what about the home builders themselves? What do these rising costs mean for them?
Yeah, it's a little bit unclear. Generally speaking, they're still expecting that home builders will see, some construction cost increases. Previously, they were expecting about $9,000 to $10,000 per home. It kind of remains to be seen what of that is going to get passed on to the consumer at the end of the day. So it's just, the tariffs are so complicated that there's still a lot of uncertainty about what this means. And, uncertainty is a really difficult, feeling for the market and for this industry.
And you mentioned home buyers feeling uneasy, right? This cannot help. And I also imagine, it creates some uncertainty around pricing as it goes forward, too. So home buyers, when they're going out and looking, what do they now have to consider?
Right. So one economist that I was talking to this morning pointed out that a lot of home buyers keep their down payments in the market. So when you have a day like today, when stocks are down 4%, maybe even more, that could really cut into their purchasing power pretty much immediately. Potential home buyers, if they're maybe worried about their job, that might also cause them to just sort of halt their process until they know more. And so it remains to be seen, but probably the market will slow down. And I have to remind everyone that the market is still very, very slow. We're still in this deep slump caused by these high rates, these affordability issues. So unless you're a cash-rich buyer who's really able to buy a potential dip, a lot of buyers are kind of in a tough place right now.
Yeah, most definitely. Claire, thank you. Appreciate it.
Thank you.
President Trump's reciprocal tariff policies adding to the already growing economic uncertainty in the U.S. right as we're entering the spring home buying season. How could this affect the real estate market? Joining me now, Danielle Hale, Realtor.com chief economist. Danielle, in your latest report, you're already seeing buyers on the sidelines. So what is this current uncertainty, the vibe around the tariffs, et cetera? What is this going to do now to sentiment?
It does seem like it's not likely to be much help. And already, as you noted, our report showed that while sellers are enthusiastic and joining the market today at higher numbers than they were last year, buyers are showing some signs of hesitation. So we saw pending home sales, which is an early stage indicator for an actual home sale closing, fall in the month of March compared to 1 year ago. We know that buyers are contending with higher prices still, even though listing prices were flat. Sales prices have continued to tick up. Mortgage rates remain relatively high, though that may change as some of this uncertainty hits the financial markets. But buyers are looking at high costs and then broader economic uncertainty. There are several surveys, consumer confidence, consumer sentiment, the home purchase sentiment index have all shown that buyers are expressing growing concerns about their personal financial situation. And when they're making a commitment to a home purchase, which is the largest purchase people make and which is often financed over 30 years, when that confidence is undermined, it really leads to some hesitancy, which we're already picking up on in the housing market.
Okay, so let's talk about the effect of that. You've got rising inventory, although still below pre-pandemic levels. You've got buyer hesitancy. I would think that this would result in price cuts for some of these homes being offered. Are we starting to see that?
We are starting to see an uptick in price cuts. So it's worth noting that in any market conditions, there's always some sellers that are having to adjust their prices because they don't quite get the number right the first time they go to list a home. So we saw that price reductions, or 17.5% of the homes that were on the market had some sort of price reduction. And that is up compared to a year ago, somewhat modestly, but it does show that sellers are responding to some of that buyer sluggishness and hesitancy in the market. So that does put buyers in a somewhat better bargaining position. It's also worth looking at the overall price trend. So as I noted, home prices were flat compared to a year ago. We're not seeing the same increases that we had seen previously, but they've been in kind of this holding pattern on asking prices for the better part of the last year or so. But sales prices have continued to tick up. And some of that is due to more activity at the higher end on sales and more activity on the lower end for listings. So it's good news for buyers who are looking for those entry-level price points, but it does suggest that they're having trouble getting to the closing table in those lower price points.
And how much relief are buyers getting from mortgage rates at this point? And do you expect, I mean, we've been seeing, for example, today, the 10-year yield is down a lot. So I don't know what you're expecting in terms of further relief on the mortgage front.
Yeah, so the mortgage rates are starting to react to that tariff news. So I do expect them to move lower. Before this news, they'd been hovering in the 6.6 to 6.7% range, which is better than the 7% that they had seen in January, but certainly still up relative to 6.1% that we had in September. So mortgage rates are kind of in the middle. I do think we're likely to see them move lower, which will be a relief for buyers, but it's juxtaposed against this uncertainty for the broader economy and especially in the labor market that might not necessarily yield the results that we would normally expect lower mortgage rates to see because of that uncertainty.
And Danielle, finally, is there any particular regional trend that you're keeping an eye on where you're seeing perhaps surprising strength or weakness amidst all of these bigger cross currents?
Yeah, a lot of the regional trends that we see are motivated by building and the ability of builders to sort of create more housing for the market. If we take a step back and look at the big picture, the U.S. housing market is undersupplied, but is definitely not spread evenly across the country. Builders have done a better job of building in the South, to a lesser extent in the West. The Northeast and the Midwest lag behind. So as a result, we're seeing more price softness in the South and more inventory availability. In fact, some markets in the U.S., particularly in Central Texas, are back above pre-pandemic levels of inventory. So buyers in the South are in a somewhat better position. Buyers in the Northeast and the Midwest may, in fact, still be seeing price increases.
Danielle, thank you so much. Good to see you.
Thanks for having me.
We want to get a check on auto stocks now. Canadian Prime Minister Mark Carney just announcing that Canada will respond to President Trump's auto tariffs by putting its own tariffs on American cars that are imported into tariffs here. So this means Canada will add 25% tariffs on non-Canadian content of USMCA autos, that is autos that are subject to the U.S.-Mexico trade agreement, Canada trade agreement, and then we'll add 25% tariffs on autos that don't comply with that agreement as well. The auto tariffs will not affect parts that are crossing the border and will not apply to Mexican vehicle content. All of that according to Prime Minister Mark Carney. At the same time, Carney is saying the impact of U.S. tariffs on Canada is, quote, monumental, and calls the threats from the U.S., quote, unjustified, unwarranted, and in our judgment, misguided. There also have been already a number of layoff announcements at Canadian car manufacturing facilities. Coming up, we're breaking down student loan interest and how it accumulates, the types of plans available, and what to do if you're worried your payments are too high. That's next on Wealth. All week long on Wealth, we're talking student loans, and today we're narrowing in on interest and repayment. A report from the New York Fed estimated that as many as 9 million Americans could see their credit scores lower due to overdue student loan payments. Joining me now in studio with more on how borrowers can avoid joining that group is Peter Granville, the Century Foundation Fellow. So, Peter, obviously there's been a change in the past 5 years that's now changing again. So how do we get here to this situation?
Yeah, so federal student loan borrowers had about 3.5 years in which they did not need to make federal student loan payments. On top of that, there was one more year in which the consequences of not making your monthly bills were not as severe. That has now changed. It's now been enough time that people are really facing these risks of default and potentially, on the way, delinquency and your credit score going down. And that's very serious.
Yeah, let's talk about that credit score piece of it. So how and why does the credit score get hit? How long does it take for you to not pay your loan for it to affect it? How does that all work?
Yeah, so your credit score is a function of your history of making your bills that are due to you. So if you are not making your monthly student loan payment for 90 days or more, that's when that information is going to go to these credit agencies. That's when potentially your credit score is going to go down as a result. That's going to make it harder to borrow more money in the future. So auto loans, mortgages, getting those things are complicated enough, so don't make it more complicated by missing a federal student loan payment, which you could potentially make.
And so if you're a new grad who are just finishing their education, how long do they have before they have to get on it and start repaying?
Yeah, so the idea is you're taking out a student loan to get a good job, which will help you, have a good livelihood, have a good life, and also pay off your student loans. So these loan programs have grace periods in which it's about 6 months very often where you're getting that good job. A lot of people, especially right now, are finding that can be kind of tough. And so if you are at the end of that grace period and realizing, oh, actually, I'm not quite as ready as I thought to make that monthly payment, you do have options. So you can talk to your servicer about a deferment, especially if you have things like medical expenses that are very high right now. But also, you can look for income-driven repayment plans. The website of the Office of Federal Student Aid has a calculator where you can put in your own personal information and find out what plan is going to be best for you. That can lower your monthly payment based on your income and family size.
And how do you find out what your loan rate is, and can you also renegotiate that rate in some cases?
Yes, so you want to find out who your servicer is. They have all of the information about that. The way to find out who your servicer is through the Office of Federal Student Aid website. Again, find your FSA ID from when you filled out the FAFSA and got this whole process started, and then log into that website. That's a lot of steps. This can sound very confusing. I remember I was 23 years old, fresh out of grad school. I was getting emails from what turned out to be my servicer, and I didn't know it was my servicer. So I sort of ignored a couple emails, and only once I clicked on it did I realize, oh, they have my loan.